Hi guys, let's do Bennedicts. Bennedicts traders trades in the retail industry, and due to the fact that the entity's turnover have not exceeded the threshold set out in the VAT Act, Bennedicts are not registered for VAT. The entity commenced with trade during July 2012 and buys and sells one type of calculator, the SHIRP A38. Financial year end is 28 Feb. The following information is supplied to you. Opening balances as at 1 March. Inventory, 20 units of the SHIRP A38, 30,000. And then they give you purchase transactions. They bought 100 units, 120 units, 55 units. With each and every purchase, there's a note attached to it. Now, the first thing that must come to mind if you see a question like this is I have units and I have total values, and therefore I must have unit prices. So if you have units in a question, then immediately you know that your calculations should be in table format. Okay, and then it's note 1, 2, and 3, and 4. It's all to do with the purchases. General information. In terms of inventory valuations, Bennedicts applies the first in, first out method. Very important. Bennedicts paid the following to its advertisements to promote a new improved version of the SHIRP A38, newspaper advertisements and local radio station advertisements. These two are total normal operating costs. Got absolutely nothing to do with the cost price of the unit. At year-end, the accountant established that the SHIRP A38 calculator can be sold in the foreseeable future at 1,850 per unit, and the expected delivery cost, which is part of the package when you buy the calculator, will be 50 Rand per unit, with an expected compulsory commission to the sales agents amounting to 15 Rand per unit. All these prices exclude VAT. Now, this needs to happen in the future. Why do they give me this whole sing song and dance? And the reason for that is this is all about your net realizable value test that you have to perform at year end. During the year end, 28 Feb, 189 units of all SHIRP 38s that were available for sale have been sold. At year end, consumable materials 2,500 Rand were still on hand. What do we have to do? We have to present the applicable notes pertaining to inventory in the Statement of Financial Position of Bennedicts Traders as at 28 February 2017. Show all your calculations. Should any item be omitted from the value of your calculated account, clearly state the reason for such an omission, and comparative information is required. Important, is required. Good. So what do we calculate? What do we show in the Statement of Financial Position? Closing inventory. So this is a very nice way of asking us to determine what was the value of closing inventory. And then we should know that inventory is shown at the lower of cost or net realizable value. So before we can do the disclosure of inventory in the statements, we will have to perform the net realizable value test. Good. Now let's start at the beginning. We said first thing that we want to determine is what was the value of closing inventory. In order to do that, we're going to obviously have to start with opening inventory. So in our answer, we say, well, let's start here. Calculations, we are going to start with our opening inventory. Opening inventory was 20 units and the total Rand value was 30,000 Rand. So typically what you will see in a table format is the units, probably a unit price, Rands per unit, and then Rand value. So start with the 20. Now we're going to do the purchase transactions. Now the first purchase transaction that took place, let me just get rid of it. First purchase transaction that took place was this one on the 15th of March where we bought 100 units. And then they tell us the purchase price exclusive of that before any discounts was taken into account, any type of discount. So that will include settlement discount and trade discount, was 160,000. Bennedicts bought goods on credit from vendor A, that's got to do with that purchase transaction, named Makisaki. Due to the high volume of his units purchased, Makisaki granted a bulk 2% trade discount. So that needs to come off the 160,000. Bennedicts settle the account within 15 days after the purchase and receive a further 3% settlement discount. Bennedicts transported the goods themselves to their premises and the following expenses were incurred. Fuel, 280 Rand. If I didn't put in the fuel into the delivery vehicle, I couldn't have received the vehicle, the merchandise, so I could not sell the merchandise. So therefore, I am able to capitalize the fuel cost. Toll fees. Well, I probably had to travel on the toll road, so therefore I had to incur the 150 Rand toll fees. So I'm allowed to capitalize that. But for sure, I didn't have to travel more than what the speed limit is, so I cannot claim or capitalize the cost of the traffic fines as part of the cost price of the goods. Now, I suspect one mistake that a lot of you have made is, there you see the purchase price exclusive of that 160,000. But a lot of you, I think, has forgotten that Bennedicts are not registered for that. So therefore, what is the value that must be capitalized as part of the cost price of an inventory item? That will be the invoice value. And the invoice value will be inclusive of VAT if I buy from another VAT vendor. And Makisaki is a VAT vendor. So you will have to remember, because we cannot claim the VAT, that the VAT in this instance must now be capitalized as part of the cost price of the goods that we have purchased. So let's have a look at what is the total value of those 100 items that we did purchase from Makisaki. We bought 100 items, so that's our units. And the VAT exclusive price was 160,000. So 2% was the trade discount that we have received that we're going to subtract from the 160,000. Then we have received a further 3% settlement discount, but based on what? The invoice value, which would then be 160,000 less 3,200 Rand. That times 3% gives us 4,704. Now we must remember that we also have to include the VAT. Now, what would have been the value of the invoice? The value of the invoice would have been the 160,000 less 3,200 times 14%. But then on the allowance or the settlement discount that we have received, we would have paid VAT as well. So we might as well just take that, subtract all the discounts and multiply that by 14% to get the net VAT amount, which is 21,393. So if we're going to add all these items together, that gives us a total of 173,389. An alternative way of calculating the 173,389 would have been the 160,000 times 98% minus the 2%, times 97%, i.e. minus the 3%, multiplied by 1.14. And that would have given you 173,389 as well, which is exactly the same as what that answer there is. Now the additional cost that we have incurred was the fuel cost of 280 Rand. We are able to capitalize that. The toll fees of 150 Rand. We are able to capitalize that. And then the traffic fines is not a necessary expense. And the question states, if you want to omit something from a calculation, you must state the reason why. And the reason it's not a necessary expense in order to get this item into my possession to enable me to sell it. So therefore, I'm not able to capitalize that cost. So in total, these 100 items have costed sum total of all of those of 173,819. Going back to the question, on 31 August, we bought another 120 units and the VAT exclusive price was 198,000 Rand, referring to note 2 and 3. Going to note 2, 16 units referring to the purchase that took place on this date were returned to the supplier for goods being Ross Accessories Pty Limited, a non-VAT vendor. So what was the value of the invoice that Ross Accessories have issued to Bennedicts? Only 198,000 Rand, because he is not able to add any VAT to that because he's not a non-VAT vendor. After various emails and phone calls between Bennedicts and the supplier agreed to refund 75% of the value of goods returned. Now, that is not equal to 100% of the cost price of those 16 items that was returned. So I'm only going to receive a credit note from the supplier equal to 75% of the value of those goods returned. So that means 198,000 divided by 120 times 16 units which was returned multiplied by 75% is going to be the value of the goods returned. Due to the fact that a cash transaction was done, Ross granted a cash discount of 8,700 Rand, a fixed amount in this case. So I have to deduct the 8,700 Rand from the total cost of these goods. Also note number 3, the goods purchased on 31 August was transported by an entity called Speedy Deliveries, who charged Bennedicts 956 Rand inclusive of VAT. But remember, Bennedicts is not a VAT vendor. So Bennedicts can now capitalize the full 956 Rand as part of the cost price of the goods acquired. Upon offloading the goods, storage space became a problem at the warehouse of Bennedicts, and consequently additional premises had to be rented in order to safeguard the goods. The rent paid for the additional warehousing paid in cash to a rent warehouse amounted to 1,900 Rand exclusive of VAT, and they are registered for VAT. Storage cost, we are not allowed to capitalize at the end of the process. In other words, it was stored after they've received the goods, so that cannot form part of the cost price of the goods acquired. Okay, so let's start there right in the beginning. The acquisition of the 120 items of 198,000 Rand. 120 items, it costed us 198,000 Rand. 16 items were returned, so 198,000 divided by 120, multiplied by the 16 units, multiplied only by 75% because that was the value of the credit note issued. Gives me a total of 19,800. It was sent back, so I have to reduce the value of the cost price of the goods. Also, I didn't acquire 120 items. I only really acquired 104 items. So I have to deduct the 16 items from the 120 as well. So in total, I have acquired 104 items. Additional costs or income or whatever you want to call it that I have to take into account was the cash settlement discount what we received. So that reduced the cost price of the goods purchased, and that was a fixed amount of 8,700 Rand. Transport costs was 956 Rand, and I have to use the VAT inclusive price because we are not a VAT vendor and we are not allowed to claim VAT. Therefore, the full 956 Rand must be capitalized because VAT in this instance is a non-claimable amount and therefore it must be capitalized. The renting of the warehouse, we are not allowed to capitalize that because it's not a cost that we incur to get the item into our possession and in order to allow us to sell the item. So the total cost of these 104 items was 170,456 Rand. Then on the 15th of Jan, we bought another 55 units for 85,250 Rand, exclusive of VAT before any discounts was taken into account. Note number 4. The goods purchased on 15 January was from Sherp Head Office. Sherp Head Office, an entity registered for VAT. So, if they were registered for VAT and that was a VAT exclusive price, we must remember we have to add the VAT because the VAT for us is a non-claimable expense and therefore we must capitalize that as part of the cost price of the items purchased. Sherp Head Office informed Bennedicts that the new improved batch of A38 calculators first had to be installed before it could be sold to the public. Bennedicts paid 9,800 Rand inclusive of VAT to an expert on these improved calculators. Good. So, inclusive of VAT, we have to capitalize the VAT inclusive price because we are not a VAT vendor. So that definitely will form part of the cost price of that items, because without the installation, we are not allowed to sell the item. 55 units were properly installed, and that was also the number of units that we've purchased. So all those units was correctly installed. Going back then, if we want to calculate what the purchase price of these 55 items was, it was 85,000 exclusive of VAT. I must add the VAT now, which is 14% of that amount, 11,935. The installation cost I have to add, that inclusive price, 9,800. So if I'm going to add all those items together, it gives me a total of 106,985 for the 55 units. Good, general information. In terms of the inventory, Bennedicts applies the first in, first out method. Bennedicts paid the following to its advertisements. We've already said it's got nothing to do with the cost price of stock. This we said is net realizable value. And we said that 189 units were sold during the year. So we can work out how many units were available to sell in the current financial period. We had 20 units, we bought 100 units, we bought another 104 units, that one there, oopsie, go back there, 104 units, and we bought another 55 units. So if we add all that number of units together, 20 plus 100 plus 104 plus 55, it gave us a total of 279 units which was available to be sold. 189 units were sold during the year, so that means that there were 90 units on hand at the end of the year. First in, first out means that we have sold from the top to the bottom first. So the 20 units in the opening inventory would have been the first that we've sold. Then we would have sold 100, etc., etc. So if we have 90 units on hand at the end of the financial year, it means that our last purchase of 55 units was still on hand. So 90 units less 55 units gives us 35 units. So 35 units of that purchase of 104 units was also still on hand at the end of the year. We know that the 55 units has costed us 106,985. 35 units has costed us 170,456 divided by 104. That will give us the unit price per unit, multiplied by the 35 units on hand, and that gave us a cost price of 57,365. So the cost price of units on hand at the end of the year was 164,350 Rand. At year end, we know that we have to perform the net realizable value test. So at year end, we established that the selling price in the foreseeable future is 1,850 per unit. But then there are certain compulsory selling costs involved. And it's only compulsory selling costs that we have to deduct from the estimated selling price of a unit in order to determine the net realizable value. So the first necessary cost was the delivery cost, and that was 50 Rand per unit. And the second cost was a compulsory commission to the sales agents of 15 Rand per unit. So that needs to be deducted from the selling price per unit in order to derive at the net realizable value. So the net realizable value of the 90 units on hand was 90 multiplied by 1,850, the expected selling price. So in future, we expect to receive 166,500 for those units sold. Then the compulsory selling expenses was the transport cost of or the delivery cost of 50 Rand per unit. 50 times 90 gives us 4,500. And guys, it's a cost that we're going to incur. So therefore, it must reduce the expected sales proceeds, the amount we're going to receive for that unit. The other selling expense, which is also going to reduce the sales proceeds, is going to be the commission that we have to pay the sales agents, which was 15 Rand a unit. So 90 times 15 Rand a unit gives us a total of 1,350, which we have to reduce our sales proceeds with. So our net realizable value of those items on hand was 160,650, which is now the lower of the two. Cost price 164, net realizable value 160, so the lower one of the two is going to be 160,650. We will have to pass in our accounting records an entry to reduce our cost price of inventory. So we're going to credit our inventory account with the difference between those two, and we're going to debit a net realizable value adjustment, which is an expense account with the difference between those two. The net realizable value expense account will be closed off eventually against cost of sales. So it's going to reduce our cost of sales or increase our cost of sales. Sorry, it's going to be a debit against cost of sales. So it's going to increase our cost of sales for the year under review. Good. The question will ask us to disclose or present the inventory notes to the financial statement. So now we're only going to answer the question. Up to now, we haven't answered the question. So strictly speaking, if you only have done all the calculation, but you didn't answer the question, you would have lost in your first year 50% of the total marks of the question. And in the second year, they wouldn't have even marked your question. Obviously, in the third year thereafter, also not. So make sure that somewhere along the line, you start by answering the question. So even if you only wrote the skeleton of the question, then you would have received all the marks for your workings should you not be able to finish the question in time. Okay, so notes to the financial statements for the year ended 28 February 2017. Accounting policy note, inventory. Inventory is valued at a low of cost or net realizable value. The net realizable value is the expected sales value of the items on hand after compulsory selling costs were deducted. The cost of inventory is valued by applying the first in, first out method. They want comparative figures, so I have to give 2016 Rand and 2017 Rand. Inventory note, trading inventory. Last year, that's my opening inventory for the year, 30,000. Trading inventory, now you only show the amount, in this case the net realizable value, because that is now the new value of your inventory for the year, 160,650. 160,650, which was the net realizable value because it was lower than the cost price, and that is why that is the value that you're going to show in your statement, because in your books you have written down your inventory to 160,650. Oops, that's Afrikaans, is the English. 160,650. Then in the question, they also told you that at year end, consumable materials to the value of 1,500 Rand was still on hand. So obviously that forms part of your inventory note. Consumable stores 1,500, 162,150. What is not here, and it should have been there, is that you should have said that a net realizable value adjustment of, now the difference between that two is 164,350 less 160,650 is 3,700 Rand. Of 3,700 Rand was made during the 2017 financial year as a result of a lower expected selling price of the items on hand. So you have to mention the fact that there was a net realizable value adjustment, you have to mention what the amount was, and you have to mention what was the reason for that net realizable value adjustment. Goodie, that's the end.